What is happening, crypto fam? Buckle up, because the market is a whirlwind of activity, and you need to know what's going down. We're diving headfirst into the latest seismic shifts, the data that's blowing minds, and the strategies that could redefine your portfolio. We're exploring the crucial balance between Bitcoin's steady performance and the explosive potential of altcoins in today's complex crypto landscape. How are savvy investors navigating this fragmentation to maximize gains while minimizing risk? We've got the breakdown. Then, we're talking about the game changers: Bitcoin ETFs and centralized exchanges. Discover how this powerful duo is fueling institutional adoption and supercharging liquidity, creating a symbiotic relationship that's reshaping the entire ecosystem. And that's not all. We're also dissecting the massive rotation from Bitcoin to Ethereum in August's ETF flows and looking at the short-term risks Bitcoin faces despite record whale profits. You won't want to miss any of this. Make sure to hit that like, subscribe, and ring that notification bell so you never miss an update. Navigating the crypto maze: Bitcoin's anchor versus altcoin rockets. In the ever-evolving and often fragmented world of cryptocurrency, a critical question emerges for investors. How do you effectively balance the inherent stability of Bitcoin against the often explosive, yet volatile, nature of altcoins? This isn't just a theoretical exercise. It's a strategic imperative for anyone looking to thrive in the current market. We're seeing a landscape where Bitcoin, often seen as the digital gold standard, provides a degree of predictability, while a vast universe of altcoins offers the potential for exponential growth, albeit with significantly higher risk. The challenge lies in understanding the unique dynamics of each. Bitcoin's price action, while still subject to market sentiment and macroeconomic factors, tends to be less prone to the dramatic, overnight swings that can characterize smaller, newer digital assets. Its established network effect, broader institutional acceptance, and larger market capitalization contribute to this relative stability. For many, holding Bitcoin is akin to securing a foundational asset within their digital portfolio, a hedge against the more speculative ventures. However, ignoring altcoins means potentially leaving substantial gains on the table. Many altcoins, powered by innovative technology, unique use cases, or strong community backing, can and do outperform Bitcoin significantly during certain market cycles. Identifying these opportunities requires deep research, a keen eye for emerging trends, and a robust risk management strategy. The fragmentation of the market, with thousands of distinct projects, means that discerning genuine potential from hype can be an arduous task. Investors must consider factors like the project's underlying technology, the development team's expertise, the tokenomics, the community engagement, and the overall market sentiment towards that specific sector or coin. Successfully allocating capital between Bitcoin and altcoins involves a careful calibration of risk tolerance, investment goals, and market outlook. Some strategies involve a core holding of Bitcoin, with a smaller, more speculative portion allocated to a diversified basket of high-potential altcoins. Others might involve actively trading altcoins during periods of high volatility while maintaining a long-term Bitcoin position. The key is to develop a framework that allows for flexibility, enabling adjustments based on changing market conditions and the performance of individual assets. Understanding on-chain data, market sentiment indicators, and upcoming project developments are crucial tools in this ongoing strategic allocation process. It's about building a resilient portfolio that can weather the inevitable storms while capitalizing on the remarkable opportunities that the crypto space continues to present. This delicate balancing act is a hot topic among traders and analysts alike, with many debating the optimal percentage allocation for different risk profiles. Now, let's shift gears and explore how institutional players are making their mark, and what that means for the future of crypto liquidity. ETFs and exchanges, the institutional power couple. In the rapidly maturing landscape of digital assets, the interplay between Bitcoin exchange-traded funds, ETFs, and centralized exchanges is proving to be a pivotal force, driving significant institutional adoption and dramatically enhancing market liquidity. This symbiotic relationship is not just a trend. It's a fundamental shift in how traditional finance engages with cryptocurrencies, creating a more accessible, regulated, and liquid environment for a broader range of investors. Bitcoin ETFs, particularly those approved in major markets like the United States, have acted as a crucial gateway for institutional capital. These financial products allow traditional asset managers, hedge funds, and even retail investors to gain exposure to Bitcoin's price movements through familiar, regulated investment vehicles. Unlike directly purchasing and holding Bitcoin on an exchange, ETFs offer the convenience of being traded on traditional stock exchanges, often with the oversight of established financial institutions. This familiarity and regulatory compliance significantly lower the barriers to entry for large capital allocators who might otherwise be hesitant to engage directly with the crypto market due to custody concerns, regulatory uncertainties, or internal compliance policies. Centralized exchanges, on the other hand, play an indispensable role in facilitating the underlying mechanics of these ETFs and the broader market. They provide the infrastructure for buying and selling the underlying Bitcoin that ETFs hold, as well as offering a vast marketplace for direct crypto trading. The liquidity provided by major centralized exchanges ensures that there are always buyers and sellers available, which is essential for the smooth operation of ETFs. When there is high demand for an ETF, authorized participants can create new ETF shares by delivering Bitcoin to the ETF issuer, a process that relies on the deep liquidity pools of centralized exchanges. Conversely, when investors redeem ETF shares, the issuer sells the underlying Bitcoin, again impacting the exchange markets. This dynamic creates a powerful feedback loop. Increased institutional interest, channeled through ETFs, drives demand for Bitcoin. This demand is met by the liquidity on centralized exchanges, which in turn can lead to price discovery and market stability. As more institutions enter the market via ETFs, the overall trading volume on exchanges increases, attracting more market makers and liquidity providers. This enhanced liquidity makes it easier and cheaper for everyone to trade cryptocurrencies, further boosting adoption and potentially leading to more innovative financial products. Moreover, the transparency and regulatory scrutiny associated with ETFs often lend a degree of legitimacy to the underlying crypto market. This can encourage further innovation and the development of more sophisticated financial instruments, such as derivatives and lending products, all of which rely on robust exchange infrastructure and deep liquidity. The growth of Bitcoin ETFs, therefore, is intrinsically linked to the health and efficiency of centralized exchanges, creating a mutually beneficial ecosystem that is crucial for the mainstream acceptance of digital assets. The ongoing growth of Bitcoin ETFs is a clear indicator of the market's increasing maturity and the growing comfort of traditional financial players with digital assets. Now, let's turn our attention to the Asian markets and see how investor sentiment is shifting, particularly regarding a significant rotation in ETF flows. Asia Morning Briefing: The Great ETF Rotation BTC Out, ETH In. August delivered a striking reversal in the flow of institutional capital into cryptocurrency ETFs, marking a significant moment in market dynamics. For the first time since both Bitcoin and Ethereum spot ETFs launched, Bitcoin ETFs experienced substantial net outflows, shedding approximately $751 million. In a stark contrast, Ethereum ETFs quietly absorbed a massive $3.9 billion during the same month. This divergence is more than just a blip. It signals a potential rebalancing of institutional exposure, with investors seemingly rotating their capital from Bitcoin towards Ethereum. This shift is particularly noteworthy because it breaks the pattern established in previous months, where Bitcoin ETFs consistently attracted inflows, fueling the asset to record highs. The recent outflows from Bitcoin ETFs suggest a cooling of institutional enthusiasm or a strategic reallocation of assets. Market observers are closely watching to see if this trend continues, as it could have significant implications for the price trajectories of both leading cryptocurrencies. On-chain data further underscores Bitcoin's current fragility. A recent report from Glassnode indicates that Bitcoin has slipped below the cost basis for both 1-month and 3-month holders. This means that short-term investors are currently underwater on their positions, which historically can increase the risk of further price retracements. Should Bitcoin sustain a move below its 6-month cost basis, estimated to be around $107,000, analysts warn that losses could accelerate, potentially pushing the price towards the crucial support zone between $93,000 and $95,000. This area is significant as it represents a zone where a substantial number of long-term holders previously accumulated their positions. Prediction markets are also reflecting this cautious sentiment surrounding Bitcoin. On platforms like Polymarket, traders are assigning a 65% probability that Bitcoin will revisit the $100,000 mark before reaching $130,000. Furthermore, only about 24% of traders expect Bitcoin to hit $150,000 by the end of the year. This sentiment shift suggests that the July rally might have been overextended, lacking the sustained institutional demand from ETF inflows to provide robust backing. Meanwhile, Ethereum has been the beneficiary of steadier institutional inflows. Ethereum ETFs have recorded positive net subscriptions in 10 out of the last 12 months. The impressive $3.9 billion haul in August alone contributed to Ethereum achieving a remarkable 25% gain over a 30-day period, even amidst a generally rough week for the broader crypto market. This consistent institutional support is providing Ethereum with a quiet ballast, potentially marking the beginning of a significant rotation narrative heading into the year's end. While market observers note that crypto charts, including Bitcoin's below $108K trading price, appear bearish enough to potentially signal a bullish reversal due to cleared leverage and anticipated Fed decisions. The ETF flow data presents a compelling counter-narrative of shifting institutional preference. This substantial rotation from Bitcoin to Ethereum ETFs highlights a dynamic shift in institutional investment strategies. Now, let's pivot to examine the potential short-term risks facing Bitcoin, even as record profits are being realized by some of its largest holders. Bitcoin's tightrope walk, whale profits versus short-term risks. Despite the overarching narrative of digital asset growth and increasing institutional interest, Bitcoin is currently navigating a period marked by significant short-term risks, even as its largest holders, known as whales, are realizing record profits. This juxtaposition paints a complex picture of the market, where entrenched wealth coexists with potential volatility, driven by factors like on-chain metrics and investor behavior. The emergence of record profits for Bitcoin whales is a testament to the asset's remarkable performance over time. These large holders, who acquired significant amounts of Bitcoin at much lower prices, are now sitting on substantial unrealized gains. The decision of when and how to realize these profits can have a considerable impact on market dynamics. If a significant number of these whales decide to sell, it could create downward pressure on Bitcoin's price due to the sheer volume of assets being moved. Simultaneously, on-chain data reveals concerning trends, specifically spikes in coin days destroyed, CDD. CDD is a metric that measures the total number of days that all Bitcoins spent in a wallet have been destroyed, effectively indicating the movement of coins that have been dormant for a long time. A spike in CDD often signals that older, potentially less liquid coins are being moved, which could indicate selling pressure. When whales move large quantities of Bitcoin, especially after long periods of dormancy, it can be interpreted by the market as a signal of a potential sell-off, leading to increased caution among other investors. Furthermore, the market is closely watching for signs of potential capitulation or profit-taking that could exacerbate short-term price fluctuations. Metrics such as exchange net position changes and the realized profit-loss ratio are key indicators. If exchanges see a net inflow of Bitcoin, it typically suggests that holders are moving their assets to exchanges for potential sale. Conversely, outflows usually indicate accumulation. The current environment, characterized by high profitability for long-term holders and observable shifts in older coin movements, creates a delicate balance. While the underlying demand for Bitcoin, bolstered by factors like ETF inflows and growing adoption, remains strong, these short-term risk factors cannot be ignored. Investors are therefore advised to monitor these on-chain metrics closely, alongside broader market sentiment and macroeconomic news to navigate potential volatility. The sustained profitability of whales, coupled with the increased movement of older coins, suggests a market at a potential inflection point, where strategic decisions by large holders could significantly influence short-term price action. This analysis of short-term risks highlights the dynamic nature of the crypto market, where even strong underlying trends can be influenced by the actions of major players. Now, let's delve into the fascinating world of ETF flows in Asia and uncover a potential major rotation from Bitcoin to Ethereum. And that's a wrap on today's essential crypto updates. We saw a strategic look at balancing Bitcoin stability with altcoin volatility, explored the powerful synergy between Bitcoin ETFs and centralized exchanges driving institutional adoption, dissected a major rotation from Bitcoin to Ethereum in August's ETF flows, and analyzed Bitcoin's short-term risks amidst whale profits. Stay informed, stay invested, and most importantly, stay safe out there. Don't forget to smash that like button, subscribe for more deep dives, ring the notification bell so you never miss a beat, and follow us on all our social channels for real-time updates. We'll see you in the next one.